Thank you, Elise, and welcome everyone. Good to see you online. We've got about 20 minutes together to talk about markets. And I'm going to make the case that offshore global markets are fairly expensive and offer some degree of risk. And actually, there's more opportunity right now in South Africa, in the equity market and in the bond market. So let's get into it. World market cap. This is the totality of equity markets, $115 trillion. Think about world GDP is about $85 trillion. So fairly elevated, and you can see how well equity markets have done since the global COVID crash, or GCC as we now call it. And markets have not looked back since March of last year and are hitting new highs. And led really by the United States. We've all seen the technology shares doing incredibly well. This is the NASDAQ composite in red, and in blue the S&P 500, again at record highs. And what's driving them? Vaccine penetration is giving investors hope that recovery is around the corner and indeed coming through in economies fairly quickly now. And vaccine penetration in the developed world is very strong. In the emerging markets, not so strong, and that's an issue we can come back to. But in developed markets, very strong, and that is giving hope for recovery. And if you look at vaccines and the current wave, this is a little bit hard to see, but if you match the lines up, in yellow, this is the UK, in yellow are COVID cases, and in purple are COVID deaths. This is the previous wave in the UK. You can see that cases and deaths were pretty much the same. Over here is the latest wave in the UK. COVID cases up a lot. COVID deaths, right at the bottom, are flat. So COVID is still around, but vaccines are meaning that people aren't dying and not going to hospital. Not quite the case in South Africa yet, but globally in developed markets, that is the case. And that's meant that money is poured into equity markets. You can see here that the largest annualized inflow to equities ever in the first half of this year. Sorry, about $600 billion flowed into equity markets in the first half. So a lot of flows into equity markets, and that is pushing markets higher. And investors are getting leveraged again. This is a chart of margin debt. So when you're trading on margin, you use debt to support your equity, and you lever up 2 or 3 times. That can be a danger sign when retail investors get over-exuberant. And you can see when margin debt is high, it tends to be at a point where the markets will subsequently fall. So quite a big risk factor. You can see back in 1999, 2000, tech boom and bust. Over here, 2007, 2008, high margin debt, subsequent fall. And you can see today, look how high margin debt is now. So a bit of a danger sign for global markets. And in the very near term, NASDAQ, we talked about technology shares doing, of course, very well. In the near term, on momentum indicators, NASDAQ is actually very overbought. So again, a danger signal for markets. And if you just look at the valuation of markets, look at the tech sector. This is the price to sales ratio of the NASDAQ effectively. This is the previous tech bubble, 1999-2000. The market was trading at 6.8 times sales. Today, over there, it's trading at 7.26 times sales. So historic highs. So markets are pretty expensive. And you can see it also on the broader market. This is the S&P 500 in the States. This is the real earnings yield. Okay? So the earnings yield is the reciprocal of the price-earnings ratio. Price over earnings, earnings over price is the yield. So it's the coupon you're getting off the market. And this is the real version of that, so deflated by inflation. So when the market is down here, it's very expensive in real terms. And this was expensive back in 1987, before the 87 crash. Again in 1999, before the 2000 crash. Again in 07, before the 08 crash. And look at it now. Very expensive. And as I said, led by the US. US kind of exuberance in the market. This goes back to 1950. This is the valuation of the US market compared to other world markets. What's the price action? This is the 1960s, the Nifty 50, when the market concentration got very narrow in the equity market, the so-called Nifty 50 consumerism stocks. This is the internet boom, 1999-2000, and today. Again, you can see how far the US is ahead of the rest of the world. Again, a little bit of a danger signal, concentrated in the tech stocks. And just take a look at this parallel. These are the 7 years ending March 2000. So again, go back to the technology boom and bust. The market did very well into March 2000 and then came down very sharply. And in the 7 years ending March 2000, prices in the market grew 69% faster than earnings per share. These are the earnings per share in the market. This is the price action. These are profits. This is price. 69% faster. Over there, on the 7 years ending March 2001, just gone, again, prices have just grown 70% faster than earnings. So is the market getting a little ahead of itself, particularly in global markets, particularly in developed markets? And we're starting to see investors just pull back from some of these frothy areas of the market. Meme stocks, cryptocurrencies. You can see here, non-profitable technology, IPOs, and in blue, Bitcoin-sensitive stocks. And you can see all these things kind of peaked kind of the beginning of this year, and since have actually pretty much halved. So the areas of extreme froth are kind of deflating. And again, that's a signal that investors may be getting a bit more wary of global markets, even as they hit record highs. And what are investors really worried about? It's okay having expensive markets, but what's going to derail markets if anything does? Well, investors are getting more worried about inflation. I think we've all noticed that around us globally. This is a chart of US inflation core and headline. The red line is now well above 5, in fact. This is slightly out of date. Inflation has picked up very sharply, and that is a concern for markets, that inflation will become a little bit out of control in subsequent years. And expectations are very high. So investors' expectations for inflation are at a 15-year high. So investors are worried about this. The bond market is not really telling you to be worried yet. This is the US bond yield, the 10-year bond yield in what is that, orange. And then in purple is the inflation rate. And they tend to match each other. Kind of inflation bond rates have been around 1-2% over the last decade or two, in fact. Today, they're completely disconnected. So the bond yield is down here. This is the bond yield, 1.37%. This is the inflation rate, 5.4%. And the Federal Reserve in the States is saying this is going to be transitory. The inflation spike's not going to last too long. It's going to come back down. Well, let's see if they're right or not. Let's see where inflation is coming through. We may have seen this in South Africa as well. If you're trying to buy a car, used car prices have been on a tear. In the States, this measure, they've doubled used car prices. And that's partly because of supply bottlenecks for new cars. So shortage of semiconductors into new cars is causing a shortage of new cars, and people are buying used cars instead. A lot of inflation in used car prices in the States. Iron ore prices, commodity prices have been very, very strong. As the economy's recovered, a lot of commodities have doubled, as iron ore has here. Again, that feeds through into the market in terms of inflation. Global food prices, up, what is that, 20% in the last year. That's a big problem for people's weekly shop. You probably noticed this as well within South Africa. And look at this chart of shipping rates. These are container shipping rates. So the cost of hiring a container to ship goods from China to the US or China to Rotterdam. They kind of truck along for the last decade around $1,000, $2,000 for a container. Let's say $2,000. Today, $127,000 for a container. I mean, they've exploded. So the cost of shipping a container from Shanghai to New York is today $12,000 for the container. And that again feeds through the supply chain into inflation. The housing market. This is a chart for New York and people's expectations for what they'll pay for rent in a year's time. And tenants are expecting inflation of 10% in their rental bills over the next year. So people are feeling this in their pocket. And we're seeing it in the housing market directly as well. House prices are, in many parts of the developed world, soaring. So the annualized rate on this chart is running at about 10–15% globally. And in particular markets, Canada being one, let's look at that, it's gone a little crazy. This is Vancouver. The screenshots from an actual real estate agent's website. This house, which looks relatively modest in Vancouver, is on sale for 7 million Canadian dollars. I'm sure it's a perfectly nice house. But 7 million Canadian dollars is about 80 million rand, 80. The one on the right is 11 million Canadian dollars. That's about 120 million rand. Again, very nice house. But is it 120 million rands worth? The market's gone a little crazy. And house prices today are as unaffordable relative to income as they were in 2007 at the peak of the housing boom last time. So it's more expensive to buy a house today than it was in 2007, which is the precursor to the housing crash. And there's a little bit too much money around, a little bit too much liquidity. These are Jay-Z's sneakers or tackies, $25,000 for a pair of those. There's just too much liquidity. And the Fed says inflation is transitory. So United Airlines' new $23 Wi-Fi is temporary, yes? It's going back to $8? I don't think it will. It's a problem. And it's partly because there's so much stimulus hitting the market. And you can see here, in green, this is the stimulus in 2007, 2008 in the US, 5% of GDP. Today, 25% of GDP hitting the market. This is government spending, government stimulus checks, checks in people's pockets, and it's hitting the market. Enormous amounts of stimulus, and these are central bank balance sheets, which are now growing to around $30 trillion from around $13 trillion only a couple of years ago. And that's a problem, again, for inflation on the debt load. And there's so much stimulus in the economy, compared to people's usual levels of personal savings, which is the trend line here, people's cumulative personal savings, because of these checks coming in the post, are now $2.6 trillion in the States. It's about double that globally, about $5 trillion of liquidity hitting the market. That's why you're seeing such strong retail sales growth in many places. And money supply growth coming through again, which is generally a precursor to inflation. And you can see that retail sales growth here. Non-farm payrolls, which is the kind of bold blue line. Very sharp fall off in employment in the States and some recovery. The light blue line is retail sales. So you can see how much that's recovered, and that's that stimulus coming through into people's pockets and being spent in the economy. Tends to be inflationary. And people are finding it hard to find workers. So people are not stepping up and going back into the labour market because the government's paying them so much. And we're seeing, therefore, wage inflation. Look at this quote. What struck me in recent weeks, however, is the sheer level of wage inflation coming through at the bottom end of the US labour market. Bank of America raised minimum wages by 25%, McDonald's by 10%, and Securitas is offering $1,000 sign-on bonuses for a $16 an hour guarding job. People are desperate to find workers, and it comes through in inflation, and therefore comes through in wages and comes through in end product inflation. And it's a problem for the debt market. I'll finish on these before talking about South Africa. This is a chart of core CPI along the bottom against the bond yield. You get kind of 3% inflation, you get kind of a 3% bond yield, maybe 4%. Today, inflation's 5% over here. Should bond yields be 5% instead of 1%? If they are, we've got a problem in terms of the national debt. In the States, it's $24 trillion. That's up about $20 trillion in the last decade. Or put another way, US government debt as a percentage of GDP is trading at historic highs. Too much debt in the economy, too much stimulus, inflation is a risk. Which leaves markets looking expensive on most measures. This is the price-earnings ratio going back to 1928. Historic high. This is the price-to-sales ratio, historic high. And earnings will recover. We're seeing fairly strong earnings growth coming through. But actually, we may have seen the best of it. This is actually quite interesting. Investors like the acceleration in earnings growth. And once it's peaked, it tends to have less impact on the market. And this is definitely lots of fun for investors, as what we've just been through. Earnings accelerating, recovery. This is where we are now. Maybe less fun. as the momentum starts to go out of that earnings story. And what you can say about markets is that at these kinds of valuations, it becomes more difficult to make long-term returns. So if you take the price-earnings ratio of the market at the bottom, if you're trading on about 11 times, then your 10-year return going forward is around 20% per annum. So you buy the market at 11 times earnings, you get a 20% return on average for the next 10 years. So buy the market cheap. If you buy today in the US on 22 times earnings, on average you get nothing for the next 10 years. So offshore markets are expensive. We are seeing some longer-term features coming out of a post-COVID environment. This is a chart around longer-term trends in pricing, back to 1998. In red, you can see that the level of inflation in generally service sectors. So if you take healthcare, education, housing, a lot of inflation the last couple of decades. Anything related to technology, televisions, computer software, toys from China, cell phone services, collapsed. And what is going to happen out of COVID is that we're going to get actually less inflation on a structural basis, probably over here. Education going online, healthcare innovation. That's probably going to fly in the face of the more inflation argument. The second COVID consequence is a rather tragic one because inequality has gone up a lot. This is a chart which shows you the number of billionaires worldwide. It was running at about 1,500 last year, or year before last. Today, it's doubled, 3,000 billionaires. And that's at the expense of the lower levels of society. So it's becoming a more unequal world. And you can see that in this chart, which is the wealth of the top 0.0001%, which is the top 18 families in America today. And that's exploded up to 1.4% from 0.4%. More inequality. The positive aspect coming out of COVID is actually climate change and addressing it. And people are becoming much more aware of environmental and social governance issues. And you can see here where this is going to land in terms of decarbonizing portfolios. This is very relevant for investors. Think about how to benefit from the boom in renewables and how to protect your portfolio from decarbonization issues, which is coal and gas collapsing within a decade or so to zero. So fossil fuels heading to zero in a couple of decades, maybe less than that in terms of its share of electricity production, and wind power and solar power exploding. And we saw that last year with a huge boom in renewable energy. Again, keep an eye on that for your portfolios. So offshore expensive, some good and bad things coming out of COVID. In South Africa, a very positive story, or a more positive story coming out. It doesn't always feel that way. Let's not be unrealistic. But is this the start of South Africa's comeback? South Africa is a very globally based economy. We're very exposed to commodity prices, manufacturing trends, and the global recovery in economic activity is definitely benefiting South Africa as we come out of COVID. That's factor number one, which is very positive for us. Factor number two is this commodity boom. So we have very favorable terms of trade right now. So the prices of commodities going up so much is really helping our current account. Again, a big plus for us. Third one, we are going to get, and we're seeing, a growth rebound in South Africa. Again, it doesn't always feel like it, because there are endless lockdowns and third waves, and there's tragedy all around us. But the underlying dynamics of the economy are improving. And we're expecting to see quite strong growth this year, so 5% growth in GDP, partly from that terms of trade, partly from agriculture. Agriculture is rebounding very strongly in South Africa. And we're seeing that in the fiscal deficit as well. This is the chart which shows the debt profile, which was heading to 120% of GDP. Given these favorable factors, we're going to see much less of that. So the fiscal risks in South Africa are decreasing. And that'll help in terms of investor confidence globally into South Africa as well. Inflation in South Africa has come down, thank goodness. I certainly hope it will remain at modest levels. We think it will. And inflation will remain fairly well contained in South Africa, which will make us more competitive globally. And will mean that we can keep interest rates. We think interest rates will be unchanged until the middle of next year. And that's a very powerful driving force to allow economic recovery to activity to recover as we recover from COVID. And vaccination rates are improving very substantially within South Africa, even as we speak. So that's, again, a very positive sign, which is encouraging to us. And we may even see a strong rand, kind of a continuation of a strong rand. I mean, we've seen some weakness of late, but overall the trend's been very positive, and the rand continues to be relatively cheap. So South Africa is forming from a very cheap asset class into an interesting growth story. And that's a very compelling narrative for us as we move ahead. And the summary would be risks in global markets, in equities, and some inflation risks. More opportunity domestically in South Africa, in the equity market and the bond market, and in the domestic economy. So very interesting times ahead, and that's a great message to send to our clients in South Africa, and we're very pleased to send it. And it's of great benefit as been for our clients' portfolios, and we continue to expect it to be so for the next few years. So thank you very much indeed.